Welcome everybody to Accounting Explained. I do hope that you are having a wonderful day. In this series of educational videos, you are going to watch some unique but easy to understand explanations of both basic and more difficult accounting concepts. And our topic for today is debits and credits. And the concept of debits and credits is no doubt the foundation of financial accounting. When you actually first time hear about debits and credits, they may seem like mystery. Experienced accountants often fail to explain the concept because they try to explain it in a too scientific way. We will undertake a different journey though. While still aiming to really understand debits and credits, we'll actually go through the same logical thought process which was followed by the people who invented debits and credits. And most of the time, we will stay simple and easy. No difficult words or phrases or definitions. We will apply only pure common sense. Another unique feature of this series is that we are going to stay away from the corporate world and we will be using examples from just personal finances, which are more understandable for everyone. Okay, and this is our plan. In order to understand debits and credits properly, we have to first cover some other specific accounting terms. Assets, liabilities and equity, or double entry. Then, having revealed the mysterious substance of debits and credits, we will finally speak about a balance sheet. So this series of videos has 4 parts. Each of them will take approximately 15 minutes of your time. If you do not feel fully comfortable with any of the terms that you see on the screen, you are in the proper place. Okay, and let's now have assets, liabilities and equity explained in the first session. The meaning of the first two key terms, assets and liabilities, is quite simple. Assets are things that you own, for instance, cash, financial investments, or real estate. The common feature of assets is that they can be turned into cash. For instance, if you simply sell your shares or your house, you will have more cash. Liabilities, on the other hand, mean an amount that you owe to somebody. For instance, liabilities payable to banks, liabilities payable to lease companies, or to credit card companies. The common feature of these items is that you need cash to settle the liabilities when they become due, i.e., you will have less cash afterwards. So assets ultimately mean more cash and liabilities mean less cash at the end of the day. Easy, right? And our first straightforward assumption here is that it makes sense to assume that assets have a positive value because they can be converted into cash, which is a positive thing, and liabilities have negative value because we need to spend our cash in order to repay them, which is obviously a negative thing. Let's just confirm our understanding of such a basic concept with a very simple example from personal finances. And the example is the following. Imagine that John has $100 in his pocket. We can simply say that he has a positive value of plus $100. Now, if John borrowed $100 from Kate, then he owes $100 to her. We may alternatively say that John has minus $100 because he needs his own cash to repay this loan in the future. So the money that John has in his pocket is an asset with a plus, and the money that John owes to Kate is a liability with a minus. Now, let's have a look at a more comprehensive example from John's personal finances. So let's meet John Smith again And let's have a look at all his assets and all his liabilities. Let's suppose that John owns a house worth $220,000. By the way, all values here will be shown in thousands of dollars for simplicity. John also owns shares worth 70,000 and he also has cash of 10,000. On the other hand, John has to repay a mortgage of 155,000 and finally John has a debt on his credit card of 5,000. So in summary, on the left hand side we see John's assets and we notice that assets are shown as pluses, while on the right hand side we can see John's liabilities, which are all minuses. We can actually do some very simple calculations with assets and liabilities, and we can add them up in the same way as we add up positive and negative numbers in algebra. For instance, John's total assets are 220 plus 70 plus 10 equals to $300,000. John's total liabilities are minus 155 minus 5 equals to minus $160,000. One more calculation. John's net assets and liabilities are 300 minus 160 equals to $140,000. Actually, the last number calculated as net assets and liabilities is also called equity. Equity is always calculated as a difference between assets and liabilities, and in simple terms, equity is reflecting John's wealth, i.e., how rich he is. The more assets John has and the less liabilities he has, the richer he is, right? Let's discuss the substance of equity a little bit more. And in its accounting substance, equity is a kind of special liability of John to himself while he is alive or to his heirs after his death. Actually, if John died and his children sold off all his assets for their values, and if they repaid all the liabilities right now, then they would finally end up splitting cash of 140,000. So the amount of equity represents a liability of John's estate to himself or to his heirs. In other words, equity is a liability which John doesn't owe to somebody external, he rather keeps it at home. But because equity is just a special liability, we will treat it with a minus sign as well. This fact is a bit counterintuitive because in human language we perceive equity as something positive. Remember, for now, it is only in the language of accounting where equity is presented with a minus sign. Just remember for now that in accounting both equity and liabilities have minus signs because they represent money owed, either to ourselves or our heirs, which is equity, or to external parties like banks or credit card companies, and these are the liabilities. So the key message here is, in the language of accounting, both equity and liabilities have minus signs because they simply represent money owed. But despite having minus signs, there is obvious difference between equity and liabilities. You would obviously prefer to have bigger equity, which you can achieve by owning more assets. And the bigger is the equity, the richer you are and the better is your financial situation. On the other hand, high liabilities decrease your equity. So in summary, we prefer to have bigger equity and small liabilities, although for accounting, both equity and liabilities are presented with minus signs as they represent money owed to somebody. You have probably noticed that the sum of assets, liabilities, and equity with their signs is zero, which is called the basic accounting equation. In our example, 300 plus minus 140 plus minus 160 equals to 0. Assets, liabilities, and equity obviously change over time, but at any moment, remember, their sum is always 0. Why is this? The explanation is actually super easy. At any moment, we could simply add up all our assets and liabilities, and the resulting difference is always the equity, with any numbers. So the equity is, in other words, just a residual figure or a plug-in figure or a made-up figure which is making the result of our accounting equation 0. And assets, liabilities, and equity change over time naturally because of certain financial events that take place. Remember that the zero sum must be valid after every event, i.e., after changing one item, we must change another item as well, otherwise the equation wouldn't work. Also remember that we simply increase or decrease the assets, liabilities, and equity by adding positive or negative numbers in the same way as we do it in algebra. Let's have a look at the following two simple examples. The first example is with assets. If we, for instance, own shares of $75,000 and over a month they have gained value of $10,000, the resulting value of shares will be plus 75 plus 10 equals plus $85,000. The second example is with liabilities. If we owe $6,000 on our credit card and we charge an extra $2,000 during a month, our resulting credit card debt will be minus 6 minus 2 equals minus $8,000. And we already know that equity is a special liability with a minus sign, therefore it increases or decreases exactly in the same way as liabilities. You see, changing values of assets, liabilities, and equity is easy as adding up positive or negative numbers in algebra. Believe me, there is nothing more difficult here. So in summary, in this first video, we have defined the three key terms of financial accounting: assets, liabilities, and equity. Assets are things that we own: cash, financial investments, real estate, or whatever is valuable and whatever can be sold for cash. Liabilities, on the other hand, mean an amount that we owe to somebody. Liabilities owed to banks, to lease or credit card companies. Liabilities are opposite to assets because we need to spend our cash in order to settle them. And finally, equity is an amount that we owe to ourselves. It shows how rich we are and how much money is somebody going to inherit from us. And also, we have learned that in accounting, assets have a positive value because we can sell them for cash, while liabilities and equity have negative values because we need to spend cash in order to repay them. However, equity is obviously better than a liability because with equity we keep the cash in the family, and with liability the cash goes to somebody else. And finally, we have learned that the sum of assets, liabilities, and equity is always 0, and this is called the basic accounting equation. In this equation, The equity is just an imaginative number. There is nothing physical about equity and there is no contract behind equity. It is just a plug-in number that makes the accounting equation balance. So, we are now done with the first part, assets, liabilities and equity, of our 4-part video series dedicated to debits and credits. You have done a great job and now you are welcome to go ahead and watch parts 2, 3 and 4 in order to get a full understanding of debits and credits.